All right, let's get started. This is your 20-minute Annuity Tuesday. My name is Trent Zimmermann. I'm the Director of Annuities here at BGA Insurance. BGA Insurance is a GA specializing in life, annuities, long-term care, and disability. And myself, I have a bachelor's with a focus on economics, a master's in finance. I'm a chartered financial consultant and life underwriter. And this is your 20 minutes. We're going to be talking about cap and pars. But before we do, I do want to go on a bit of a tangent because there was something happened last week that stuck with me over the weekend and sufficiently bummed me out. And a few weeks ago we did a wake up call before this talking about the 60 billion in MIGA's multi-year guaranteed annuities that are coming up for renewal this year and the over 400 estimated billion of annuities that are sitting outside of surrender right now. Um, I don't know if that was a wake-up call to many of you, but this second piece was. And why are we here? And that's the first piece of this. I'm sure a lot of you are here because you're looking to drum up some more sales. You're looking for a best use case scenario. You're looking for some sales ideas. You're looking for some techniques that some of our top salespeople do. Um, but we're here for a noble cause. We're here to make sure people get to retirement and make it through retirement. And we're also here for long-term care. And we had somebody who had reached out to me over a year ago, asked for a bunch of different illustrations, looking at different ways to look at an individual getting long-term care. And they sat on it and called them, followed up, uh, every month to say, hey, where are we at with this? And they were getting in their own way. And finally, they called me last week and said, hey, I'm going to meet with this person. Can you hop on the phone? Absolutely. I'm always happy to hop on the phone with agents of ours who need help explaining this and going through this with their clients. And so we planned it for Thursday. Don't get the call, call them, don't get an answer. And then that night, I get a text from the agent saying, uh, my client ended up in the hospital and is going to need long-term care for the rest of her life. Could have done something, and so we're here to we're here to help people. We're here to make sure they get the coverage they need. We're here to make sure they can get through retirement. So don't wait. Don't wait. Because we also had another situation this week of somebody else who had asked for illustrations, and that person had a heart attack, quadruple bypass. Now they're waiting. Probably won't be able to get insurance, but if they do, it's going to be a couple of years from now. So don't wait. This is stuff your clients need. This is stuff they need to get on top of immediately. People who have these estate planning seminars will tell you probably 40% of them, if not 60, 70%, depending on how you slice it, are there because of a wake-up call, either between themselves or their family or friends. So don't wait. We've had a couple situations in the last few weeks of people, you know, heart attacks, hospitalizations, and now they can't get their life insurance, they can't get their long-term care insurance, they can't get the coverage they need. So it's always going to happen. There's always going to be wake-up calls, but be on the front end. There's 60 billion in MIGAs coming up for renewal this year. And if they're not planning on using that for their retirement, talk to them about repurposing it for long-term care expenses. Um, whether that be hybrid long-term care or annuities, we can do a meeting on that in the future. But now let's dive into cap and pars. We're talking cap and pars. We're talking about fixed index annuities. You've seen this slide. We've talked about this slide before. Historical performance of of fixed index annuities, good, bad, volatility control, equity-based, whatever it is, all of them in is 6.88%, whereas the historical performance of the S&P is 10.44. So it's people advertise this as beating the S&P, maybe in highly volatile markets, maybe in down markets, but it's a different type of asset. It's more comparable to bonds in terms of yield and risk tolerance. In fact, even less risk than bonds when you talk about downside risk. But we're looking at, the top end of bonds yielding 6.3, the remainder being under 6, and the 30-day Treasuries being at 3.4 on a historical average. So all these fixed index annuities are going to be linked to indexes, S&P, NASDAQ, and that's built by taking the funds you put in and dumping them into the reserves, and then buying uh, fixed income assets. And those assets are going to be yielding 5%, let's say. And that is going to pay for the company's profit, uh, the recapture of the cost of distribution, which is paying the commission to you guys, any guarantees. So every annuity has annuitization built in. That's how you get the tax status of an annuity, even if they're not designed well for it anymore, for MYGAs or for fixed index annuities. They're designed for the guaranteed lifetime income riders. They still are going to have to cover some costs for guarantees just to create an annuity. Uh, they're also going to have restocking the reserves in their own company, so they have backup capital and surplus in case anything goes wrong. And then the remainder, which is usually between 1% and 2.5%, is going to be buying options. And it's going to be based off of the 5 to 10 Treasury yield because that's what we're tracking mostly. Um, and what we're looking for is notional. Notional is the face value of these options. You don't really need to know what that is, but that's the math problem is if they paid 7% in commission and now you have, for sake of ease, $93. They're sitting in these reserve funds, and they bought with their 2.5% yield an option, and that notional yield is $5. $5 divided by 93 is going to be your cap. Sorry, by the original 100 is going to be your cap. So all these are going to be tracking the 10-year Treasury yield. It's not going to be tracking the fund rate. So when we're looking at the Fed funds, if there's a big drop there, it's going to take time for that 10-year Treasury yield to trend down towards that level. They are closely related. They are not married. Uh, so expect when you hear any changes in the Fed funds, there is going to be a change on the horizon, but it's probably not going to be a large one. It is good for drumming up business and saying the rates are about to change. Uh, but it's not going to be massive movements. Now, with that being said, all these companies learned a lesson. It's referred to as the ZIRP lesson, but it's a zero interest rate period between 2020 and 2021, where the 10-year yield was between 1.5 and 2%. And if the profit these companies are making is around 1.5%, because that's the fixed cost that they need to cover, plus the guarantees, plus covering the distribution costs, um, these companies had no choice but to collapse the options budgets and lower caps to 2 to 4%, if that, in these FIAs. So if you were locked into a long surrender period, then you bought into one of the worst option budget environments uh, in the insurance industry, which led them, a lot of these companies, they were already doing this, but investing in more private credit. Private credit is uh, making non-bank loans to companies. We talked about this in our private equity uh, episode. Um, they're not available in publicly traded markets. They're not transparent. Insurance companies have been doing this for a long time. It's accelerated uh, immensely in that period. There was an ALIRT report. If you're not following ALIRT, it's life insurance ratings and investigating their financial, much more forensic than S&P. It makes you a lot more comfortable selling some companies. There's some A-rated companies that have terrible alert scores. There's some B-rated companies that have some incredible alert scores. It's much more designed for the life insurance and annuities industry, and it's much more hands-on forensic investigative. And they found that this was the first year private placed bonds exceeded standard bonds, 51%. Now you've seen between 2016 and 2025, those private bonds have accelerated, over doubled, whereas public bonds have stayed virtually the same. And we've seen a large movement of private equity in buying up life insurance companies in order to capture permanent assets. And these private equity companies have really transitioned over that time of purchasing life insurance into private credit companies. Now, private credit, if we want to understand this and the research that's gone around this, we do have a private equity session you can watch, but their average return is 9.5%. So that's going to be higher than bonds, lower than equities. Default rate is at 1.01%. So obviously that's going to be more than government bonds, but lower than corporate and high yield. And price standard deviation is going to be 3.5%. It's on par with Treasury, lower than corporate, and obviously lower than equities. It's mostly correlated with stock prices. It is a little bit correlated with the Fed rate. And when I say stock prices, based on the Russell 2000. And then the remaining 40% of its correlation is based on the skill of the underwriter. Now, this is all based off of the CDLI, which is made public for private debt. So we also have had reports from the Wall Street Journal that a lot of these private equity companies are miscategorizing their investments. They're taking on more loss than expected. They're calling software companies anything but software, and they're providing loans to their owned companies that they can't IPO. So it's been a mess in this whole system. And according to the ALIRT report, there are going to be talks between the Fed and life insurance companies in the following months to make sure they are categorizing these correctly. We'll have a follow-up on that in the future. But this has all been an effort to increase the bond yield so that you're not subjected to zero interest rate periods. And there's also been a second step of creating these volatility controlled indices, of having a stable and lower option pricing, less sensitive to market volatility, insensitive to interest rate risks, hopefully more stable and attractive parameters, and they claim better value for money. But how are they getting multiples on this participation rate? Well, because the cost is so low, that notional we mentioned earlier can provide a upside that is, let's say, double of what the yield of that index is. And so that's why when you're looking at these different indexes, you might see a S&P volatility controlled at 5% that is going to have a 200% participation rate, or 10% that's going to be 100% participation rate. Whereas the standard S&P, this graph shows that 26%. Right now, it's somewhere between 45 to 55 on most carriers. Now, their argument for that is we've created less sensitive indexes with higher notional, and that is going to yield greater than the S&P. But what we experienced in 2020 was a massive crash in the bond market, and at the same time, a crash in the S&P 500. Those correlated. If you listen to the index standard, they're saying that was a once in 100-year situation. And all these volatility controlled indexes were designed for bonds and stocks to move in opposite directions as they typically do. And so we haven't seen a recovery from that. Most of those have been averaging in the 2%. So if you're getting a multiple between 200 and 250%, you're getting 4 to 5%. which on a standard basis, fine, great. You could be getting a MIGA that would be yielding more on a guaranteed basis, and you could be getting a pretty high cap S&P at somewhere around 9 to 10%. Um, that would yield more. And this is the part in the last 5 minutes where, I have no more slides. This is just us talking about evaluating these companies. So if you're looking at companies that are buying options to yield good caps and pars, and you're looking at companies that are going to honor that over time, what are we looking for? We're looking for companies that publish their renewal rates and publish their financials. And then we're going to follow up and look at their alert score and see how well they fulfill their financial commitments. And so if those things align, that they have uh, great published reports on their renewal rates, of course, all these companies have incentives to paint the story in their own light. Um, and they publish their financials. They're able to be investigated, and ALIRT is coming out saying that they are meeting their financial commitments or greater. Uh, then we can put some faith into the fact that these uh, caps are going to stay. Now, there comes a second piece here that we don't know the future of change of leadership, change in ownership, outside investment at these companies. And so from there, we're looking at where they're incentivizing you to put money, who's controlling that money, and is it on par with the market. So if I see somebody come out with a 12 to 13% cap on the S&P 500, which no one has, but if that were to come out and the rest of the high cap market is between 7.5 to 10%, that's it's pretty obvious to see that that is priced to fall in the next couple of years. If they're incentivizing volatility controlled indexes that are run by the same private equity company that own them, I think that is a self-interest that is hard to get around. Um, that looks more like they're trying to pad themselves. And now we look at companies like an Allianz out there, or Mass Mutual, who have in-house options traders, and they're able to keep costs down. That's why they're able to get better cap and pars. There's some room in there to say because of their structure, they're able to keep costs under control to make sure that they can provide higher cap and pars. The same is true with commissions. You'll tend to see, the 7% commission rates at the top end, paying lower cap and pars and incentivizing more volatility control that's controlled by their own private equity. Whereas the 5 to 6% uh, commission rates, you're tending to see much higher equity-based caps that have staying power. So that becomes the question for you. Are you willing to take a percentage less and put somebody in something that's not going to be locked up for 10 years, maybe 5 to 7 years, and get another sale in 5 to 7 years because you have a happy client versus taking the extra percent, locking them up for 5 to 3 more years, and possibly having somebody who's upset at the end because they were in a volatility controlled index that was yielding them 2% over those 10 years and they missed out on gain, and they could have been in a guaranteed product like a MIGA that could have yielded them north of 5%. So when you're talking to clients and having these conversations, they are also all these companies are tracking you. I told my wife we needed Reynolds wrap for the kitchen, and she opens up Amazon, and on her homepage there, it's advertising Reynolds wrap. They're going to be advertised as soon as they're talking to you about annuities. They're going to be seeing marketing rates on there to try and incentivize them to come over. The 20% bonus, free money that's coming in. So you need to be prepared to have these conversations with them of why something that maybe has a lower cap that's going to stay at that cap longer in a standard S&P instead of this volatility controlled AI intraday index is going to be better for them in the long run, and how your goal is to keep them happier, and how maybe you're taking a percent less by giving them the better product. Learn to tell these stories because these are the things that are going to keep clients happier in the long run. Now, that's the end of my presentation, but I do want to say this before we end. That alert report is a great read. It's 11 pages. It's quick. You can knock it out in 20 minutes maybe, but it's a good uh, pulse of where the industry's at with private placement debt, the upsides, the downsides to it. You can also watch our private equity, but I think this one's a lot more analytical than the one I did. So if you want that report, make sure to send me an email or give me a call. I'll send it over. Again, we have our fact finder as well. We have our retirement software that we're able to punch it into and give you the likelihood of them being able to outlive their assets and the benefit an annuity could provide in increasing those assets over time in retirement, and able to dial in on what that size of the annuity might be. That would be right for them. If you want those as well, email me, call me, and I am now going to launch our next week's topic for the vote. We're looking at pairing annuities with buffered assets in order to make sure you're never selling in a down year. The AUM protection plan, how to design the portfolio so that you're less at risk for massive RMD hits that could reduce your assets under management. Buy income and invest the rest. That's pretty self-explanatory. Finding that the perfect amount. And long-term care planning. Long-term care planning has been a popular hit. Whenever we send out the email, it's the most popular read email that week from us. So, and that one especially, we want to talk about indemnity versus reimbursement, and how you can even pair those two together to create a really great long-term care plan. I'm going to give you another 30 seconds to get your votes in since we're tied in a couple. And one's pulling away. So I'm going to end the poll here. And it looks like we're doing long-term care planning next week. Pairing annuities with buffered assets has been, always second place. So maybe I won't post a poll next week and just do that the following. But with that, that's all I have for you. Does anyone have any questions, comments, concerns? Want to tell me who they like for the Kentucky Derby, how they think the Angels blew the game against the Royals the other day?
Ducks almost took out the Oilers.
Ducks are doing well. First playoff win in 7 years, 8 years.
The Angels have decided to blow the entire decade, not just a
That's
10-run lead or whatever.
that's not fair. It's been a lifetime of that.
I
That's
I
it's
I I grew up with the Tim Salmon, Garrett Anderson World Series team as a
yeah.
as a young kid in that World Series era. So I've been locked in on the Angels ever since, and it's been nothing but misery. So
Perfectly amateur or
it pairs
mediocre.
it pairs very well like a good wine and a steak with my love of the Buffalo Bills, my love of the Buffalo Sabres. It's just misery all around, Trent.
I'm
I
so
get it.
sorry.
I'm a Chargers fan and a Tottenham fan, so it's all pain into it.
Oh, the Spurs. All right. All right.
Getting relegated.
Oh, oh no. That's pretty Spursy.
Yeah. Yep.
They
All
are
right.
not
Anyone
getting
with any
relegated.
questions?
There's 4 weeks to go.
I know we might get back. I don't have much hope.
I'm like so happy for the Kentucky Derby because I mean, even if you lose, you got a name like So Happy.
All right. I'm calling it. Unless anybody has any questions, you have my information. If you need the fact finder, if you need the alert report, and if you want to run through some scenarios in our retirement simulation software, give me a ring. And if you have any cases you want to take a look at, give me a ring as well. Thank you all, and I'll see you next Tuesday.